Put Apple on four screens. A trader, an investor, a quant, and a fintech engineer can all be looking at the same company, the same ticker, and even the same market beta. But they are not asking the same question. The trader asks, what opportunity exists now, and how should I enter or exit? The investor asks, what is this business worth, and should I own it over time? The quant asks, can this be defined, tested with data, and turned into a repeatable model? And the fintech engineer asks, how do data, orders, money, and ownership records move through a system correctly? In the previous episode, we mapped the banking, payments, markets, clearing, settlement, and custody system. Now we need to ask what people actually do on top of that system. And this is where most comparisons go wrong. Trading and investing are financial activities. Quantitative finance is a method, a discipline, and a family of roles. FinTech is the product and infrastructure layer that makes financial activity possible at scale. So we will compare them across 8 dimensions: objective, time horizon, unit of work, data, systems, skills, risk, and what success actually means. Then we will put them back together because in practice they overlap. Trading means taking, changing, or closing positions in response to prices, liquidity, or risk. The objective may be profit, but it may also be hedging, market making, or reducing an existing exposure. And trading does not automatically mean day trading. The horizon can be microseconds, minutes, days, weeks, or months. What defines it is the focus on the position and the process of entering and exiting. The unit of work is usually a decision: buy, sell, hold, reduce, or hedge. For an Apple trade, the trader may care about the current price, bid and ask, volatility, order book depth, position size, and transaction cost. The systems may include market data feeds, an order management system, and real time risk controls. The risks include adverse price movement, leverage, poor liquidity, slippage, and market impact. Success is not simply being right about direction, it is the result after costs adjusted for the risk taken, the drawdown, and the consistency of the process. Investing means allocating capital to assets or businesses for future income, appreciation, or long term compounding. The investor is not asking what can be traded in the next 5 minutes. The investor asks, what should I own, how much, and why should this asset create value over my horizon? That horizon may be months, years, or decades. The unit of work is usually a portfolio decision. Select an asset, estimate its value, choose a weight, rebalance it, or remove it when the thesis changes. For Apple, an investor may study revenue, margins, cash flow, capital allocation, competition, valuation, and industry conditions. The systems may include fundamental research platforms, portfolio management systems, performance attribution, and custody. The risks include permanent capital loss, paying too much, concentration, and horizon mismatch. Trading can exist inside investing. An investor still needs to buy, sell, and rebalance, but trading is the implementation activity. Investing is the capital allocation objective. Quant is not simply a third holding period between trading and investing. It is a way of approaching financial problems. A quantitative practitioner translates a question into variables, data, assumptions, models, and tests. That method can support high frequency trading. It can also support a 10-year factor portfolio. It can price an option, estimate credit risk, optimize execution, or detect fraud. For Apple, a quant may treat the company as one observation inside a large cross-sectional dataset, or as a time series, or as the underlying asset of an option, or as one exposure inside a portfolio and factor model. The unit of work may be a hypothesis, model, signal, optimizer, or risk estimate. The data depends on the problem: prices, trades, order books, financial statements, corporate actions, and alternative data. The systems may include research pipelines, backtesting engines, optimizers, model services, and production monitoring. Quant also has its own risks: bad data, look ahead bias, overfitting, and the gap between research and production. Success means more than producing a beautiful backtest. The result must survive unseen data, realistic costs, changing conditions, independent challenge, and implementation. A quant can therefore be a trader, investor, pricing specialist, or risk analyst. The defining feature is the disciplined use of mathematics, data, and computation. FinTech is not a market view and it is not an investment strategy. It is the technology, products, and infrastructure used to deliver or operate financial services. A FinTech team may build a wallet, a digital bank, a brokerage, a market data interface, a ledger, or an investment application. Its objective may be to let a customer fund an account, view a price, place an order, receive a fill, settle the transaction, and see the correct position afterward. For a fintech engineer, Apple may appear as a security master record, a market data symbol, a tradable instrument, an order object, a settled position, and a custody record. The data includes transactions, balances, identities, prices, orders, events, audit trails, and reconciliation records. The systems include interfaces, databases, ledgers, payment rails, market data pipelines, security, observability, and compliance controls. The risks are operational: incorrect balances, duplicate transactions, stale data, failed settlement, fraud, downtime, reconciliation breaks, and regulatory failure. Success may be measured through correctness, reliability, latency, reconciliation quality, customer outcomes, and compliance. A fintech engineer may build the platform used by the trader, the investor, and the quant. And that is why these categories overlap. A discretionary trader may use judgment and experience. A systematic trader may use quantitative models. A fundamental investor may use company research. A quantitative investor may use factors and statistical evidence. A quant developer may build the research and production systems behind those decisions. A fintech engineer may build the brokerage, ledger, or settlement infrastructure those workflows depend on. The categories answer different questions. Trading asks, what position should change and how should it be executed? Investing asks, where should capital be allocated and why? Quant asks, how can the question be modeled, tested, and repeated? FinTech asks, how can the workflow operate correctly in the real world? So for the trader, Apple is a tradable position. For the investor, Apple is a business and a long-term financial claim. For the quant, Apple is a defined object inside a model and dataset. For the fintech engineer, Apple is an instrument moving through data, order, account, settlement, and custody systems. None of these views is automatically superior. They solve different problems. So if you are choosing a direction, do not begin with the tool. Do not choose quant only because you like Python. Do not choose trading only because you like charts. Do not choose fintech only because you already build software. Choose the type of question you want to spend years solving. If you enjoy positions, execution, market decisions, and fast feedback, trading may fit. If you enjoy businesses, valuation, and long-term capital allocation, investing may fit. If you enjoy mathematics, evidence, modeling, and testing, quant may fit. If you enjoy interfaces, data flows, ledgers, and production systems, fintech engineering may fit. But a label still does not tell you what a real job looks like. A trader, portfolio manager, quant researcher, quant developer, fintech engineer, and financial product manager may all work inside the same organization and still have completely different days. So next, we need to map the actual roles, what each person owns, which skills they use, what they build, and what a portfolio project for each career should prove.